In this video, I'm going to discuss in detail how many trading opportunities market gives you in a month. In this discussion, I'm going to show you that Forex market, including gold, which we trade on MetaTrader, is giving very less opportunities to trade in a month. So this will actually let you understand the exact idea of the accuracy, number of possible unique trades. I'm not talking about trading number of trading positions. So accuracy, number of unique trades, and how you can allocate your risk among the trades. So to understand it better, I'll take you to the chart and I will show you between Wednesday and Monday how many trading opportunities was given by the market. Unique trading opportunities which can be executed in one single trading position or may be executed as 10 or 20 trading positions. So that is where I will also make you understand how you have to evaluate any trading statement or do trade analysis once you look at the trading portfolio of somebody else or trading portfolio presented by any company. So here we are on MetaTrader and I will show you Euro USD. On Wednesday, we discussed after US Treasury buyback news that the US Treasury buyback program will strengthen US dollar in the longer run. However, it can push US dollar to the downside. That was simply a trading opportunities for the day or slightly more than a day against US dollar. Euro USD was rising, GBP USD was rising on that particular day. You can see this movement to the upside. USD JPY on that particular day had been falling, USD CAD had been falling. So basically it was a trade of US dollar, and gold against dollar of course was also rising. That was the movement of Wednesday, retracement similar to what we saw on Euro USD and then further upward continuation. So if we wanted to trade this as many different trading positions diversified into different instruments, we could have traded one trading plan as couple of positions, one position in Euro USD, one in pound versus dollar, another one is USD JPY, another one in USD CAD, another one in gold. So we could have diversified that one trading plan into 5 different trading positions into these 5 different instruments. However, we cannot say that these are 5 unique trading opportunities. Or we could have also used split positioning on different price levels in one instrument. For example, in Euro USD, we could have opened 4 positions, and similarly we could have opened 4 positions in each of these 5 instruments, which could have traded 20 total positions between Wednesday and Thursday. However, these were not 20 unique trading opportunities, and if you simply look at the trading statement of somebody, that person can show you that okay, I have 20 profitable trades between Wednesday and Friday, and you would be, oh wow, what a nice trading performance. So that's why you shouldn't just look at number of trading positions and how many trading positions succeeded into profit and how many failed into loss. Rather, you have to understand the difference between gross loss and gross profit. Otherwise, you will be duped by such kind of claim that the people are making profit with 90% accuracy. This is how they do this. When market is very clearly moving in one direction, influenced by one simple news, which is not getting contradicted by any other economic news or geopolitical news for a particular period of time that we have seen recently between Wednesday and Thursday, then that one news can give you a chance to trade into 5 different instruments for purpose of diversification, which can result into 20 trading positions, all profitable, and a guy will come to you showing that hey, I made 20 profitable trades. And let's say even if you lose 5 trades on Monday, then he can still boast that out of 25, 20 trades were profitable. But what is the reality of this 25 trades? That there was one unique trading plan. And then let's look at how many other trading opportunities were given by the market. In the weekend, we got news that the US and Canada are not going to make a trade deal, which of course was a bad news for Canada, and USD CAD started going up, which is why you could have seen that the USD CAD opened on Monday with an upward gap which was not filled by market, and it started continuing to the upside after minor retracement for 4 hours after opening of the market. So yes, this again was a unique trading opportunity. I say that something is an unique trading opportunity only if that particular trading plan is supported by a combination of economic or geopolitical news or data and technical setup, not just a technical setup. If we simply consider technical setup, then again we can say there is another trading opportunity just because USD CAD has retraced to the downside and again started continuing to the upside. This is a trading opportunity but not an unique one. This simply is moving in the same direction, so you can just add one more trading position into the same direction, that is the buy of USD CAD. This is not a unique trading opportunity. That is exactly why I said that a person could have diversified that one trading plan based on US Treasury buyback into 5 different instruments, which could have resulted into 20 trading positions because market kept giving second, third and fourth trading opportunity in the same direction. Just like now we can see that the USD CAD is right now giving you opportunity to enter buy again in the same direction after this retracement. But this is not an unique trading opportunity. What was unique trading opportunity? Let's look at gold. Gold has a different kind of movement after this initial retracement. I will show you a comparative analysis. This retracement to the downside in Euro USD and GBP USD, this one, I guess not, this one in GBP USD are pretty similar to this downward movement in gold. However, gold continued to the upside. GBP USD and Euro USD did not continue to the upside. Do you know why? Go back to the US Treasury buyback video which we have posted. We clearly said that the buyback program will make US bond market much safer, which will attract foreign institutional investor in long run, making dollar strengthening dollar in long run. So that's why the effect of that particular news will fade up, maybe after a couple of hours or maybe after a day, maybe Wednesday, Thursday, and that's why they didn't last more than 1.5 days. The total influence collectively didn't last more than 1.5 days, and that's why downward retracement and downward movement started in Euro USD and GBP USD, and we have got double top pattern here. We have got double top pattern, not double top, some sort of different kind of reversal pattern on GBP USD as well, where you can consider this as a left shoulder, this as the head, and this as the right shoulder. My point is these two pairs are giving you a pattern to trade them to the downside, and reason is clear that the news of US Treasury buyback has been priced in, and now longer term effect is gonna push these two pairs to the downside. However, that is not going to push gold to the downside, because gold is now being moved to the upside by the fact of global trade war. Trade war between US and China is well known to everybody. Now trade war between US and Canada started because they didn't end up into agreement. And whenever there is such kind of geopolitical tension, whether it is related to the real war or trade war, it of course ends into strengthening the best safe haven instrument, which is gold. So that's why gold has a different kind of movement, which can be considered as an unique trading opportunity, because the movement after Thursday in gold is not similar to what we can see in Euro USD and GBP USD or other dollar pairs. So this is driven by its own new factor, that it is now working like a safe haven, and this is stronger than gold, stronger than dollar. So this is another unique trading opportunity. So between Wednesday and Monday, we have Wednesday, Thursday, Friday and Monday, 4 working days, and hardly 3 unique trading opportunity. One which was totally based on US Treasury buyback, another one which was based on disagreement of US and Canada, and this which is based on buying the safe haven. 3 unique trading opportunities. So this is how many unique trading opportunities you get in 4 working days. Now there are 20 working days in a month, approximately 21 and 22, but I believe that nobody is going to work on all the working days, so let's consider 20. and now you can understand how many trading opportunities will be available on the table if we are getting 3 out of 4. So let's calculate 20 multiplied by 3 divided by 4, 15 trading opportunities. So you are going to get only 15 trading opportunities, and even if you take advantage of one trading opportunities into opening 10 or 20 positions, you can have 300 to 400 trades. You can have 300 to 400 trading positions, but we can't say that we can allocate the risk according to the number of trading positions. Traders do not allocate risk according to number of trading positions, but they allocate risk on the unique trading plans. Let's say you want to risk 5% on one unique trading plan, then your total risk on 15 unique trading plans is 75%. And let's say out of 15 you lose 10 times, you lose, let's say your accuracy is only 60%, you win 10 times, lose 5 times, then 10 minus 5. The net profitable trades that you get at the end is 5, and 5 into 5, then you can end up making this kind of profit. But is it very advisable? No. What if you consecutively lose 10 trades? 10 unique trading plans, all, let's say they go into loss. So out of 10, then you will end up losing 75% of your account. Sorry, if 10 consecutive trading plans go in the loss, then 10 into 5, 50%, yes. So then you will end up losing 10 into 5, 50% of your entire account. And now if this will happen hypothetically, if it happens, then you will have to make 100% profit to recover from the remaining balance. So that's why nobody will suggest no one to use 5% on every single trading plan. You would like to keep it half, let's say 2.5%. But once we keep it 2.5%, then the 60% accuracy will end up giving you 12.5% in a month, not 25% in a month. But this will ensure that even if you lose 10 times consecutively, if all the 10 unique trading plan fail, then you will still lose 25%, which can be recovered easily in the similar period, because with remaining capital of 750, if you have to recover 250 on a $1,000 account, then you have to make only 35.71%. So let's say if you lose 25% in a matter of a quarter or a matter of couple of months, you can recover the same by slightly greater period. So that's why we suggest people to have very less expectation, because if we want to reduce the risk, it is only possible if we can reduce the profit expectation. Otherwise, the risk appetite should be higher, and you should also have the ability to reinvest or replenish the account by a new investment. Now, I will show you something how people dupe you or fool you by telling that they have 90% accuracy or 90% win rate. They do this because you do not check the ratio of their gross loss and gross profit. For example, in this particular portfolio, we are not claiming 90%, 80% or such kind of unrealistic accuracy. And this is not actually feasible. Even an entire unique plan can fail, and the 20 profitable trades which we discussed could have happened between Wednesday and Friday. All those 20 trading positions could have gone in loss. But the guy who made profit can show you those 20 trading positions, that okay, I made 20 profitable trades. So my point is, when people see very good opportunity, not contradicted by any other financial, economic or geopolitical factor, not contradicted by any chart setup, then they open many positions just to show you big number of profitable trading positions, just to show you your false excellent accuracy. Otherwise, in real life and real trading, it cannot be it cannot be much greater than 60% or 65%. We have 68% accuracy, something around 69. Earlier it was really great because of consecutively profitable trades up to some extent, but then it is now trading with accuracy of something around 69. Now let's look at another trading statement. In this portfolio, these are directly published by Investor Password using MetaTrader 4. You can just click on tools and option on the Windows version of MetaTrader, and you'll find an option of FTP from where the statements are published with the login and password. Now here if you look at the accuracy, current accuracy, it has fallen down to 67.7%. Roughly this also is 68%. This is very flat, not because of 100% accuracy, but because of archived trades. So the calculation system is considering archived as a name of instrument rather than understanding the real phenomenon of archiving multiple trading positions into one single entry. Anyway, so that's why 1531 lots were archived, and these entries were made as archived entries, which you can see in the history, trading history, because we are also showing the MT4, MT5 screen recordings. Anyway, so my point here is, if somebody claims to have 90% accuracy, then if somebody has $90 gross loss, then there should be only, sorry, $90 gross profit, then it's the trader should have only $10 gross loss. $90 gross profit, $10 gross loss. Then there is a meaning of 90% accuracy. Otherwise, there is no sense of talking about 90% accuracy. That's why we always show gross loss versus gross profit of every single trading instrument, and the ratio is considered as the profit factor. If you are aware of profit factor, I will tell you that the profit factor is the most and the only parameter you should look at. You shouldn't talk about the lot sizes, you shouldn't talk about the accuracy or win percent, because you can be easily manipulated by increased win percent. Just by increasing the number of trading, traders can increase the number of trading positions on better opportunities. But gross profit and gross loss is where you can really understand what is the ratio between their profitable trades and losing trades. Here, profitable trades make 303, then losing trades are making 120. So this is the actual comparison of gross loss versus gross profit. There we actually can understand that what is the ratio between losing and winning trades. So somebody says 90 to 10, somebody says I have 80% accuracy, means 80 to 20 should be the ratio of gross profit to gross loss. If it is not 80 to 20, if you see something similar to ours, then that person is actually manipulating the accuracy or win percent just by increasing the number of trading positions during very good trading opportunities and decreasing the number of trading positions during such trading opportunities which are not very good, which have some upcoming news or data that may influence them. Let's say we are going to trade something now, and we have some investors with the portfolio with slightly higher risk. They have higher risk appetite, they want all kind of trades, even the riskier trade. Then definitely that trade will be placed into their account. However, once we had very good opportunity, we traded 20 positions. Now we already are aware that this is a risky trading opportunity because it may be influenced by upcoming news or data, and let's say there is a scheduled news, we will open only one single position. So even if it will go in the loss, we will lose the same percentage which we decided to use in this particular trading plan. But it will be just one losing trade if we just count the number of trades, and then it will not affect the accuracy or win percent, but it will actually show the gross loss. So that's why you should compare the gross profit and gross loss, not just the accuracy or number of trades or lot sizes. In fact, you can simply skip them and you can simply come to this this comparison, and you can also understand what particular instrument is giving you the best, or what 5 instruments should be considered as the best and should be selected in your basket to make your customized portfolio. That is what I call customized portfolio management. And it's not just limited to selection of the instrument. There is more to that which will make this video very lengthy, so I'll stop right here and we'll discuss how we further customize trading portfolio to suit your risk appetite and profit expectation. Thank you for watching.